But let's discuss that and a lot more with Abhiram of BNP Paribas joining us on the show. Hi, thank you so much for making time and speaking with us. If I remember it right, you were still quite positive on IT despite the kind of numbers that we had seen in Q4. Incrementally, what's your view now? Are you still a buyer?
Yes, we are still buyers. And when I say that, I'm obviously talking from a long-term perspective, taking into at least a 12-month view here. Of course, we've had stocks, taking a bit of a breather. In fact, more than just a breather, they've actually fallen quite a bit since the last results and then started to recover. But I think the story is just getting started in that sense because there are a couple of angles here. One is even if companies have not been reporting good revenue numbers last quarter as well as this quarter, what is quite visible is that the deal win proportions and percentages have actually gone up and they still look quite healthy. So companies are sitting on good order books. And number two, we're starting to think that the US may not get into a recession as was the view earlier this year, and in fact may have a soft landing, so to speak. And as a result, chances are that estimates may turn out to be too bearish towards the end of the year. It's likely that you'll start to see some improvement from the second quarter. And as we head into the second half of the year, things may look a little better than expected.
Interesting. So, Abhiram, is that a blanket call across the IT universe, or would you want to classify as opposed to market cap as well, large or mid?
One of the interesting changes that we've seen in IT, especially over the last 3 to 5 years, is that what we used to traditionally call mid caps or small caps are no longer that small. Historically, we used to talk only about the top 3 or 4 companies when we took calls on deal wins, for example. But now the top 8 to 10 companies are actually competing pretty much in the same market and also winning deals quite well. And what we've also seen with companies beyond the top 4 or 5 is that their execution capability has also improved quite a lot. So in terms of delivery, I think that the names beyond the top 3 or 4 are also very much in our kind of list of companies to watch out for. And in fact, to be fair, their execution has probably been better than the top 2 or 3 companies. So it's exactly a blanket. You've got to be a little more discerning. But in terms of sheer execution, the historical mid caps are doing really well right now.
What's your take regarding the entire home building as well as the entire consumer durable space, whether it was a Polycab or Havells tomorrow perhaps? What's your take? Do you think that this is the best way to play the real estate theme by going towards the building material sector?
Well, in that space, we're actually quite selective, to be fair. There are various angles out there. One of them is the fact that companies have had a bit of an up and down in terms of execution. You've seen also margins move up and down. Competition is also quite high in that area. So what we have done actually is look at more diversified players within the consumer durable space and not just ones that are only in one area, for example, refrigerators or air conditioners and so on and so forth. So a mix of companies which have a good base across various segments is what we've been looking at. So, but to be fair, we've been quite selective in that area. Maybe we've missed out on some of that rally, especially with the cables and wires and so on. But it's not a space that we have been overly bullish on in the past 3 to 6 months.
Okay, interesting. Abhiram, where do you sense that the market is overvaluing a particular pocket or set of stocks, if you will? Because many believe that perhaps auto could be it and the valuations are looking stretched there.
I mean, autos have had a great run, but in order to answer that question, maybe it's kind of instructive to step back a little bit and see what the overall market backdrop is today. So at the moment, it almost feels like nothing can go wrong, right? I mean, we've had earnings that are keeping pace reasonably well. In fact, we may have had even some small upgrades in the last 1 month or so. If you take the bigger picture outside of India, it does appear that India is a relative performer, standout in terms of the fundamentals and earnings potential, especially compared to, say, China, where the recovery has not been as good as we expected. So the overall macro backdrop is still quite positive for equities. If at all there's a risk that's coming up, it could be later in the year, and part of it could be the fact that this relative attractiveness of India starts to go down as other countries start to work out their inflation and bring that down. And moreover, there is also talk of stimulus in China. which could again lead to a relative trade that we had in the past, maybe last year, where China outperformed India quite significantly. So I think it's fair to sit back and kind of agree that a part of this rally is also led very much by foreign flows, which have no other place to go to in some ways. And if that changes, then the talk of overvaluation in certain areas will come through. I think the space, which still looks good from an overall valuation perspective, but two areas that I think still look good. One of them is financials overall, especially large cap banks. And the second bit is IT, which we already spoke about. Autos, like you mentioned, they've done really well, but we still like the four-wheeler space quite a bit. I mean, at the end of the day, the affluent India story is still playing out. So it's still four-wheelers over two-wheelers for us.
That's the point. But, Abhinav, regarding the entire equity markets itself, what's your take? We are now very close to the 20,000 mark. Do you think that will be the top for the year, or do you see more, legs to the rally, given the fact there's election also next year? So there's a lot of positive momentum that builds up around that.
Well, actually, a couple of data points here to bring up. Firstly, our Nifty target is 19,250. And I say that with a smile because obviously the Nifty is trading above that. Now, historically, what we have noticed is that once the index crosses what we are comfortable with at a target, it means that it's time to start to get a lot more selective. And it does happen that, even if the market does not fall at the moment, because the flows are just is extremely strong, the picture there, there could at least be a consolidation, in my opinion. And maybe towards the second half of the year, investors start to focus a little bit more on the risk. Like you mentioned, as we get closer to the elections, things tend to slow down a little bit on the economy. It's quite natural. That may happen. And as I mentioned to you earlier, the relative trade of India versus other economies may also start to be questioned a little bit, let's say. And the third bit is, and we're seeing this globally, is that the savings, especially in the US, for example, are still very strong. And as consumers run through their savings, and we think that could happen in the second half sometime, there could be a slowdown in that aspect as well. So I would highlight that most of the risks that we are seeing to this target could be actually global led and from a relative perspective to India. So the target is unchanged. It's still 19,250. Normally what happens in such a scenario is that the market goes up and down a little bit, consolidates, and maybe you could have the market still somewhere around this level by the end of the year.
So where else in the market are you, feeling that the valuations are looking stretched, or you would recommend profit taking?
Well, I'm still positive on the market, like I said, and from a thematic perspective, it's very hard to think of India not being a good performer over the next 3 to 5 years. But that said, I think mid caps have rallied quite sharply, especially in the last 3 months or so. I mean, the last I checked, I think small and mid caps were up maybe about 16, 17% year to date. And that came after, I would say from the lows, they may be even higher. And when such a thing happens, you start to sit back and think, maybe that's the area I want to be a lot more careful of at this point in time. So if at all you're kind of tilting your portfolio, I would say a bias towards larger cap companies, especially those that have stronger management, better cash flows, etc., are the place to go to.
Abhiram, before I let you go, word on the financials itself, which is the pocket that you think is best placed? Is it NBFCs, PSU banks, private banks, ancillaries like insurance, etc.? Because it's become a very, very vast sector.
No, I agree with you on that. I think I mentioned earlier that we still like the large cap private banks, and there's still a lot more to go in that space. The other area that I really have been looking at off late is insurance. You see, these stocks have bounced a lot from March when there were concerns about regulatory-led issues, but between then and now they've bounced quite a bit. Of course, there also it's time to be a little more careful, but I think broadly the large 2-3 names are still looking quite attractive from a long-term perspective. So insurance is the second space. And the third thing you mentioned was NBFCs. I mean, fundamentals are still okay. I mean, there's very little to doubt what could go wrong there. But again, stocks have rallied quite a lot. In fact, year to date, many of the smaller NBFCs have rallied quite a bit. That's a space where I'll be a little more careful of, but I still think the large NBFCs have potential to give upside.
Great to have you on the show as always. Thanks for taking the time out. Let's just revisit what the market is currently at. We're still pretty quiet right now in trade, but hovering around that 19,800 print, at least for the futures.